What if I told you there are businesses so good, so cash rich, so deeply embedded in the economy that once you buy them, you never sell? Not because you can't, but because it would be too stupid to let it go. These are the forever assets, the ones that print money year after year after year. The ones you buy your time back, pay for your kid's school, and fund every other deal you'll ever do. Today, I'll show you how to find one. Hi, I'm Jon Stoddard. I help buyers close 33 million in small business acquisitions, and I've raised 50 million to fund deals. I help first-time buyers find, fund, and close their first business without wasting years chasing junk deals or losing sleep over rookie mistakes. If you're working full-time or got laid off and you're trying to acquire business on the side, this one's for you. Let's get into it. So what even is an evergreen business? It's not just long-term, it's permanent. These are companies you never plan to sell because they give you something more valuable than the big payday. They give you consistency, cash flow, optionality. And let's be real. Most people sell businesses for one of three reasons. The first one's burnout, or the market's tanking, or they need cash for something else. But the evergreen businesses, they resist those reasons. They built to survive downturns. They don't require constant attention. And they throw off so much cash, selling them feels like selling the goose that lays the golden egg. So what makes these businesses worth never selling? It starts with the moat. Here's the thing Warren Buffett's been preaching since the 80s. Buy businesses with wide moats, barriers to entry that make it hard for others to compete. Let's break that down. One of those barriers is proprietary tech or IP. Think of a company that owns a unique process, patent, or software platform. If others can replicate it, you can't leverage it. Another one is high switching cost. When a customer says, it's too much of a hassle to leave, that's power. Another one is network effects. The more people use your product, the more valuable it gets. Think Facebook, Slack, Airbnb, or even niche SaaS tools in boring industries. Another one is brand and emotional equity. This is See's Candy. Buffett bought it in 1972 for $25 million. It now does over $400 million a year, and he's never sold. Why? Because people don't just buy chocolate. They buy the feeling, nostalgia, tradition, holidays. They buy experiences. Let me ask you, would you sell an asset that gives you predictable, compounding, tax advantage income year after year just to take a one-time check? I don't think so. Let's talk strategy. Berkshire Hathaway didn't just hang on to See's Candy. They've held Coke since 1988. The cost basis, around $1.3 billion. Dividends to date, over $10 billion. That's not a trade, that's ownership. Or take Ray Dalio. When Bridgewater invested in companies tied to essential global supply chains, it wasn't about the next quarter earnings. It was about owning the arteries of global commerce. That's hard to disrupt. That's really hard to replace. Easy to defend. And another one, Google bought YouTube in 2006 for $1.65 billion. Today, it's likely worth over $300 billion. They've never spun it off, and they don't plan to, because it's not just a content platform, it's an infrastructure. That's what evergreen looks like. Let's talk about the hidden ROI here. It's not just about return on investment, it's return of sanity. See, an evergreen business gives you space. You're not on the hamster wheel looking for the next acquisition to keep the lights on. And some of these businesses, they become your holding company, your source of cash to fund everything else. They let you play offense. Like some investors today are buying up AI power plants while everyone's using the AI every day. Here's the kicker. You don't need a billion-dollar deal to do this. I saw a Quiet Riot listing, a simple food blog doing $170K a month in ad revenue from just an ad network. That's 2 million a year. 50 million visitors annually. No inventory, no office. The family that owned it, they pulled their kids out of school and cruised the world for a year while it printed money. Tell me that's not freedom. Let me break this down for you. What do you look for when you're going out there looking to buy SMB? Simple operations. If it requires daily firefighting or founder heroics, it's not evergreen. High LTV, lifetime value, and low churn. Customers stick around for a year. That's cash compounding. Strong retention without paid ad. If it runs without a Facebook ad budget, even better. Pricing power. Warren Buffett loves this. If you can raise prices without customers screaming, that's gold. And boring is beautiful. Trash removal, HVAC, pest control, B2B compliance software. The less sexy it sounds, the more likely it prints money. And you don't need more deals. You need one great deal. The funds the rest. And so here's the mind shift. A lot of buyers are thinking, I want to buy this SMB, but how do I flip it for a quick 3x profit after 5 years? But the smartest buyers, they're asking, what's the one asset I can buy right now that I'll still want to own in 20 years? They're building portfolios like Buffett, compounding. They're buying companies like C's. They're staying focused on moats, cash flow, and longevity. So let me ask you this. What kind of portfolio are you wanting to buy? So let's wrap this up. If you wanted the playbook, I used to help buyers go from working full-time to owning a profitable business. Grab my book. It's in the description below. It's $19.99. It's packed with real-world strategies to find on and off-market deals, valuations, and raise capital. It'll save you time, money, and months of frustration. You don't have to figure this out alone. You can shortcut the learning curve. I'm Jon Stoddard, and I'll see you on the next one.